In 1999, investors were pouring billions into internet companies with no revenue, no profits, and sometimes no product. Everyone said it was different this time. It wasn't. Today, AI companies are valued in the hundreds of billions. Anthropic alone is valued at $800 billion. OpenAI crossed $1 trillion. And the question that serious economists are quietly asking behind closed doors is, have we seen this movie before? Today, we look at what the actual economic data says, not the hype, not the headlines, about whether the AI bubble is real, and if it bursts, what happens to your money? First, let's be precise about what an economic bubble actually is. Economists define a bubble as a situation where asset prices rise far above their fundamental value, driven by speculation rather than genuine economic output. The classic signs are three. 1. Valuations disconnected from revenue. 2. Widespread belief that prices can only go up. 3. Large amounts of debt financing the speculation. Now here's where it gets interesting. AI in 2026 shows some of these signals, but not all of them. And the data tells a more nuanced story than either the bulls or the bears want to admit. Here's what the optimists get right. Unlike the dot-com bubble, today's leading AI companies actually have revenue. Anthropic hit $30 billion in annualized revenue in March 2006, growing 1,400% year over year. That is not speculation. That is a real product that real enterprises are paying real money for. The IMF's latest World Economic Outlook projects AI could add between 0.5 and 1.5 percentage points to global GDP growth annually by 2030. Goldman Sachs estimates AI could automate tasks accounting for roughly 25% of current work, creating enormous productivity gains. These are not dot-com era fantasy numbers. There is genuine economic value being created. But here's what the bears get right, and this is the part that serious economists are genuinely worried about. First, concentration risk. The AI boom is almost entirely concentrated in a handful of companies: NVIDIA, Microsoft, Google, Anthropic, OpenAI. When one sector drives this much of the market's gains, history shows that corrections can be brutal. Second, the infrastructure paradox. Data centers, GPUs, and compute infrastructure require hundreds of billions in capital investment before AI generates a single dollar in return. Third, the profitability gap. Despite $30 billion in revenue, Anthropic's gross margin was still deeply negative in 2024. High revenue does not automatically mean sustainable profit. Fourth, the adoption curve uncertainty. We genuinely do not know yet whether AI productivity gains will be broad-based or concentrated among a small number of firms. Let's put numbers to the comparison. In 1999, at the peak of the dot-com bubble, the NASDAQ traded at a price-to-earnings ratio of over 200. Today, AI-weighted tech stocks trade at around 35 to 40 times earnings, elevated but not 199 level extreme. More importantly, in 1999, Amazon had virtually no revenue. Today's AI leaders have hundreds of billions in combined enterprise contracts. However, and this is critical, there is one metric that mirrors 199 almost exactly: venture capital flows. In 2000-2005, AI startups globally raised over $110 billion in venture funding. In 1999, at the peak of the dot-com bubble, VC investment hit $105 billion in today's dollars. The speculative capital flooding into AI startups, many with no revenue and no clear path to profitability, is the most concerning parallel to the dot-com era. Now, the most important question: if there's a correction, not necessarily a crash, but a repricing, what does that mean for ordinary investors? 3 scenarios. Scenario 1. A soft landing, AI valuations compress by 30 to 40%. VC funding dries up for unprofitable startups, but the productive core, Microsoft, Google, Anthropic, continues growing. Most investors with diversified portfolios feel only moderate pain. Scenario 2. a sector correction similar to the dot-com crash. 80% of AI startups fail. However, unlike 2001, the internet survived, and so will AI. The underlying technology is real. Survivors emerge stronger. Scenario 3. A systemic shock. If AI-related debt, particularly among overextended tech companies and their lenders, triggers a broader credit event, this is the low probability but high impact scenario that institutional risk managers are stress testing right now. The data suggests scenario 1 or 2 is most likely. Scenario 3 cannot be ruled out, but is not the base case. So, is there an AI bubble? The honest answer from the data is yes, in parts. The speculative fringe of AI, the startups with no revenue, the GPU hoarding schemes, the rushed IPOs shows classic bubble characteristics. But the productive core of AI represents genuinely new economic value that will persist regardless of any market correction. The dot-com crash destroyed Pets.com. It did not destroy Amazon. The AI correction, when it comes, will destroy the speculation. It will not destroy the technology. What you should do: diversify away from pure play AI speculation. Maintain exposure to AI through quality companies with actual revenue. And stay informed, because the next 24 months will determine which AI companies are Amazon and which are Pets.com. Subscribe,